welcome to the business edition of PM Express with me, Philip Nanfuri. Today I want us to look at Ghana's financial sector, the banking sector, the insurance, the pensions, and the capital markets, and look at how these four are interconnected. Now you ask yourself why. In the past 2 years, we've looked at developments in the banking sector. We've looked at bailouts of some weak banks, and many have asked the question, what about the other parts of the financial sector? So if we solve what happens in the banking sector, would that be okay for the capital markets, for the insurance, and for the pensions? Well, these four are the main parts of the financial system in Ghana. And whether you like it or not, they are interconnected. So what happens in the banking sector has a ripple effect in the insurance sector, or in the pension sector, or the capital markets. And I'm here with Dr. Sam Mensah. He's the CEO of SEM Capital Advisors, and what they do here is investment advisory services. That's basically it. So we are going to have a discussion on how exactly this financial sector issues, particularly the cost of it, and then the cleanup approach, whether we can do something differently. Then we also look at the fund management industry. I'm sure you're well aware of issues that plagued fund managers in the past few months. And the SEC, that's the Securities and Exchange Commission, was up and about trying to clean up a mess. Then we look at the future of Ghana's financial industry. What can we do to avoid mistakes of the past? What we've witnessed from 2017 till date. How can we make sure that everything is better for you and I? We've heard time and time again that our banks are safer, more robust, interest rates are going down, lending rates are going down. But is that really the case on the ground? But most importantly, we want to start with the interconnectedness of this financial sector. Because some make the argument that bailing out the banks in its own or by themselves is not the end of the problem. We have to look at what's happening in the capital markets also. There was a story from Bloomberg that says the SEC is doing an audit of fund managers, and there's a hole of 5 billion Ghana cedis. So who's going to take care of this cost? We need answers to these questions. And to walk us through this is Dr. Sam Mensah. Again, I said he's the CEO of SEM Capital Advisors Limited. They're an investment advisory firm right here in Accra. Doc, thank you very much for joining us on PM Express.
Thanks for having me.
So I want to start off with the financial sector problems, particularly from the banking sector. And some have made the argument. And when I say some, for example, Dr. Richmond Etuahene, he's a banking and financial consultant. He deals with us a lot in the multimedia family. He says it should have been done holistically. So we should have taken it all, looked at the total cost of it, and dealt with it, rather than start with the banks. And now we're hearing that there are issues in the capital markets space. Will you share similar sentiments in saying that we should have done the banking sector, savings and loans, finance houses all at once, and then looked at other parts of the financial sector, or this approach we've adopted is the best?
I think in these kinds of difficult decisions, there's always a trade-off. Ideally, you would want to resolve all the financial institutions, whether it's banking, securities, savings and loan, finance houses, you would like to resolve them at a go. But the practical reality is that this resolution hits the national budget really hard. I think the estimate is that some 21 billion would have been spent to clean up the whole industry. So I think ideally you would want to resolve all the sectors at the same time. But I really don't think that we had the capacity to do that, when we had the financial resources to do that. Because a lot of things have to be done during resolutions. One of them is the fact that when people say they have deposits, or companies say they have deposits with Bank A, which is being resolved, it has to be verified. Yeah. And so if you look at the myriad of depositors in the banking system, even just verifying all their deposits and paying depositors is a huge task. Then you come to the savings and loan, microfinance, security. So just because of the enormity of the task, even if you had all the money, it would have been difficult to do all of them simultaneously.
Okay, look, we mentioned the cost of this cleanup, bailout, whatever we choose to call it, 21 billion. I ask myself, would that be the end, in your own estimation? Would that be the end of this whole debacle in the financial sector? Or there's a possibility that come a few months, the ripple effects it's having on businesses and etc. would prop up this cost even further?
I don't think we can say that if we spent 21 billion, if we, it would clean up the problem entirely. There will still be leftover issues. For example, savings and loans, some savings and loans have their deposits with the banks. Okay. Asset managers have their deposits with savings and loans. And the public have their deposits with asset managers. So by the time you go down all that entire chain, it takes a while to do that. And I see that this whole crisis is going to take us a few years, not necessarily even to work through the resolution, but to bring back confidence into the financial system. I think confidence is down, and it's going to take a few years to get that confidence back.
I like the way you've succinctly put the interconnectedness, I beg your pardon, I was speaking about, of how, because to the uninitiated, he might think that, okay, so once the bank has been solved, there's no other issue. But that link, putting all these together, is really where the problem is. Because you can solve a bank's issues, but it takes some time for funds to reach a savings and loans company, for businesses also to be solved.
You've got a bank holding deposits of an asset manager. It takes you 6 months to sort out the deposit and resolve it. So during that 6-month period, the client or the asset manager is looking for his or her money, and the asset manager is unable to pay. And so we see a multiplicity of complaints at the SEC that such and such an asset manager could not pay me back because his money is tied up in the banking resolution. So that's the challenge.
On the issue of confidence, the Governor of the Bank of Ghana, Dr. Addison, the Finance Minister, Kenneth Friata, have touted time and time again that the measures that have been put in place will prop up confidence in the sector. If you look at the numbers, yes, capital adequacy ratios will go up marginally because of the influx of the funds we are looking at. But Doc, with confidence, is the ordinary man who we are looking at. Do you really think, you just made an assertion that it will take some time for confidence to grow. As we speak now, do you think confidence has been built in the financial sector?
I think that is a very optimistic thinking. I don't think the confidence in the financial sector can be built so easily. I mean, financial confidence is different from, let's say, infrastructure collapsing, where all you need is money to bring in the engineers and the bridge is reconstructed or the road is reconstructed. It doesn't work that way. Financial sector is a question of expectations. It's a question of the trust. Okay, and when that erodes, it takes a very long time to come back. I mean, currently, we're still seeing individuals lining up at various financial institutions, maybe not banks, since the banks are being resolved, but at other financial institutions doing withdrawals. Not because they think that that financial institution is not going to be able to pay them, but it's just that they see that everybody is withdrawing their money. So they also have to withdraw their money. Yeah.
On the issue of the trigger of this crisis, a number of problems were put forth. At the top of all this was regulatory forbearance. And the Bank of Ghana themselves agree that at an institutional level, taking out individuals, there was some forbearance from the institution. Now we have the Financial Stability Advisory Council, which is a nexus between all these regulators, including the Ghana Deposit Protection Corporation. I know you have written a bit on regulation, financial sector regulation, where we are as Ghana, as a country now, with a state of development. Is this model the best for us?
Well, the current regulatory model that we have, or what we've had to date, is what we might call the silo system. You know, every segment of the market has its own regulator. We have insurance with the National Insurance Commission, Securities and Exchange Commission, banking with the Bank of Ghana, and pensions with NPRA. So it's been a silo system, and there hasn't been that much coordination between them. And the recent inauguration of the Financial Stability Council, I think, is a step in the right direction. It is going to solve the problem of one sector being left out when there are crises in the market. But it does not really quite solve all the problems, because we still have a very poor market conduct regulation. And you can think of regulation as being in two dimensions.
Okay.
There is market conduct, which is really about how business is conducted, what products are being sold,
okay,
what are the rights and obligations of all participants in the market. That's market conduct. And then we have prudential regulation, which is really about the soundness of the financial institutions.
Okay.
And what some countries have done is that they decided that, look, we don't want a distortion of mandates or roles, and therefore we're going to create one institution that focuses on market conduct regulation,
okay,
and another institution that focuses on prudential regulation, so that we don't get the mandates mixed. And sometimes there can be conflicts of interest between the two sides. So an example of a conflict of interest might be that the prudential regulator is too focused on the soundness of the financial institutions, that they don't pay attention to how they are actually conducting themselves or doing business out there. And so with that in mind, some countries have decided to separate the two, and that is what they call the Twin Peaks.
Okay.
Now, the question is can Ghana do Twin Peaks? From where we are, it's a big leap. Mm-hmm. Because doing Twin Peaks means, for example, that let's say Bank of Ghana takes over the prudential regulation of all the sector, including securities, and then another agency takes over market conduct. And it will require a complete rearrangement of the architecture of the financial system. I think many developing countries at the stage of development of Ghana have done it. They are doing it very incrementally and very cautiously, because it requires a lot of resources to rearrange the entire system. But I think that, you know, the financial stability will start us off, but it does not resolve the problem of weak market conduct regulation. Because we don't have a very strong market conduct regulation.
So with that, what can be the immediate short to medium term measure or stopgap measure to solve it? I mean, because
I think that the Bank of Ghana is well established in prudential regulation, but I think they have to step up on market conduct regulation. There are many laws about market conduct that are really not being enforced aggressively. For example, you can look at the credit bureau problem. Nobody is complying with it, and there are no effective sanctions. So that's one. Borrowers and Lenders Act is there. There's a collateral registry, but lenders are not registering collateral. And so that is all making it difficult to recover collateral when there are defaults. That leads to more loan losses and so forth. You know, so I think that a lot more can be done in the market conduct area. Some countries have used a stopgap measure by creating a Consumer Protection Bureau for Financial Services, which is not a fully established market conduct authority. But it takes away some of the load of market conduct from the central bank, because then somebody is concentrating on consumer rights with respect to financial services. So that's we can think about an incremental way of strengthening the market conduct. But I'm not sure that Ghana can, in the very near future, be able to go to a full Twin Peaks system, because it just requires a lot of resources. South Africa, for example, recently migrated to a twin peak, but they took several years
to put that
architecture in place. Yeah.
Okay. Look, you mentioned non-performing loans. The Bank of Ghana put out some information that they are written off about 2.2 billion of the books of banks with regards to bad debt. Now, I remember I read somewhere, because I wasn't born at that time. I remember I read somewhere that we had a non-performing assets recovery trust. And this vehicle was essentially put in place to buy the bad debt off the books of banks. And that institution itself becomes the one going around looking for the people who have caused these bad loans. Now, I ask myself, given our situation now, do you think we should bring back such a system like Nigeria is doing with the AMCON, or we should leave the banks to sort out their own credit risk management processes? Like, so if it goes bad, then they themselves start doing their own recoveries, or what do you make of that argument?
Well, they call them bad banks, the structures like the Non-Performing Assets Recovery Trust, AMCON in Nigeria. In America, they had the Resolution Trust Corporation that they used to resolve the savings and loans. They call them bad banks. Typically, you use a bad bank as a one-time measure, to resolve a bad situation where the banks have accumulated so much non-performing loans that the system is threatened. Okay, but there's one problem with using recovery trusts like that. There's a problem of moral hazard. Moral hazard meaning that if the banks know that, or at some point there'll be a recovery trust, they'll be careless in their lending and then the recovery of their loans. And so if you do it too often, it actually loses its value. That's why many countries they will do it once, but they are reluctant to do it again, because otherwise it becomes a part of the normal culture of banking, because and the moral hazard problem will actually exacerbate the problem of, loan losses. Okay. So I don't really think that is a permanent solution. It's a crisis resolution solution, but it doesn't really resolve the problem. What will resolve the problem is a package of things that will bring down non-performing loans.
Because I asked this question because I engaged the CEO of the Private Enterprise Federation last week on this very show, and he says in the run-up to this government coming into power, as part of private sector solutions to problems, they proposed an establishment of such a body to deal with the bad debt of the banks, like we saw from Bank of Ghana's asset quality review report that came out and then told us that most of the assets of these banks were severely impaired and deteriorated and whatnot. So I think what you're proposing, I think I would buy the moral hazard argument, because it's something that keeps on coming up within the financial circles, and even with lending processes and other things, you would want to curtail moral hazard to its barest minimum. But you raise an issue of lending, and I was going through, just to feed this into our conversation, I was going through some data from the Bank of Ghana, and most of the loans are concentrated in the commerce and finance sector in Ghana. And some of these sectors also, where the banks channel most of their funds, are the same sectors that give us the non-performing loans. And I ask myself, somebody looking back and will say, the banks are being lazy. Is it the case that the banks are being lazy, or they are doing the most with the little they have in the economy?
You mean banks are being lazy in the sense that they are not doing proper risk assessment and proper recoveries?
No, and then in addition to that, they are lending to sectors where the returns are quick. They're not putting money into the long-term sectors that we want to see. What's your argument on that?
Okay, so let's start with the argument about putting money into those the short end of the market. I think by definition, banking is actually mobilization of short-term deposits. And then in order to maintain your margin, you know, of the duration, you also lend short.
Yes.
So just by the nature of banking, the bulk of their lending is short term. So you can't take somebody's money for 3 months and then lend it out for 5 years. Okay, so that's the maturity mismatch problem.
Okay.
Is there. It's not. It's just the nature. Banks always have some core deposits which they can use to lend long, but it can't be a major part of their portfolio. So that's one reason. But the other, if you say banks are being lazy in terms of other things like as risk assessment and recoveries, I would say that there are a number of structural bottlenecks in the system that actually, and I'm not defending the banks, I think they need to do better, but there are a number of structural bottlenecks in the system that we can work on to reduce the incidence of loan losses. One of them, for example, is the proper use of the credit bureau. Like banks are supposed to report all borrowings to the credit union, a credit bureau, and they're supposed to access a borrower's file on the credit bureau, from the credit bureau when they are lending. But this is not being diligently done. A lot of financial institutions are not even reporting to the credit bureau. So that's one area where we can easily make some gains. Another area where we can make gains is the use of the collateral register. Because people are using the same collateral for loans in different banks, and because the collateral registry is not being honored by financial institutions, when there's a loss, it takes a lot of litigation to actually recover the collateral. So we call all this credit infrastructure. You know, we need to step up our game with the credit infrastructure, and then structurally you'll see that the loan losses will slowly come down. They won't be completely eliminated.
Okay.
Yeah, but okay. I think banks can also do better. We've always known that banks have capacity weaknesses when it comes to assessing risk in certain sectors of the economy. Okay. So we have to continue to work on those areas.
Okay. This is the business edition of PM Express. My name is Philip Nanfuru, and my guest, Dr. Sam Mensah, CEO of SEM Capital Advisors Limited. We're taking a quick break. When we get back, we'll look at the fund management industry. That's Doc's main industry. He's a financial economist by profession. He plays in all sectors, but what he does on a day-to-day basis is work in the fund management, asset management industry, investment advice. We want to look at that and see the issues that came out of there, particularly from the Securities and Exchange Commission's groundwork they did and trying to clean up their own sector. This is the business edition of PM Express. We'll be right back. Thanks for staying with us. This is the business edition of PM Express. My name is Philip Nanfuru, and my guest, Dr. Sam Mensah, CEO of SEM Capital Advisors Limited. Before we go into the break, we're looking at the financial sector in totality, and we've seen how interconnected the four main areas of the financial system are. We've also learned that regulation is key in the financial system. However, we practice what Doc calls a silo system, where each financial sphere is headed by a different regulator. So we have the Bank of Ghana for the banks and specialized deposit-taking institutions. We have the National Insurance Commission for the insurance companies. We have the National Pensions Regulatory Authority for the pensions, and we have the Securities and Exchange Commission for the capital markets. Now, I want us to delve into the capital markets because in the last few months, we've also seen developments in the fund management industry. And some keep asking me, Philip, what's the difference between a bank, a fund manager, assets manager, broker, custodian? Where do all these institutions lie? They fall largely under the Securities and Exchange Commission. But let us hear it better explained from Dr. Sam Mensah. Doc, fund management industries, asset management industries, broker-dealers, custodians, registrars, etc. All these come under the Securities and Exchange Commission. Now, in the past few months, the fund management industry has undergone a couple of changes, a couple of problems. Give us your take on where you feel these challenges came from.
From several sources. Let's see if we can pick out the key ones. The first one has been the regulatory capacity of the Securities and Exchange Commission. You know, currently as we speak, there are about 140 licensed fund managers or investment advisors. And the Securities and Exchange Commission, I think, has been stretched over the years. So it has not really been able to do the effective surveillance of all these 140 fund managers. So the fund managers have actually had a field day. And some of them have actually crossed the line in terms of doing things that they are not supposed to do. Strictly speaking, what fund management is that the client gives you their funds, you help them develop an investment profile and then an investment strategy, and then you invest the funds on their behalf based on understandings that you've reached with respect to the client's investment objectives. And you work for a fee, not for a return.
Okay.
So, strictly speaking, that's what fund management is. You're a fee-for-service institution. But what some of the fund managers have done is actually try to work for returns by promising an investor that if you put X amount here for 3 months, you'll get 25%, something like that. Okay, so then they start taking on the role of a deposit-taking institution because now they are committed to paying the 25% in regard to the promise that they made. So that makes you start behaving like a deposit-taking institution. People are depositing funds, you are promising them a return, and you're paying them. Now, but you don't have the balance sheet to do that kind of work. Your balance sheet is very small in terms of your own equity. I mean, as of now, the minimum capital to get into fund management business is 100,000 cedis, which is very low. Your balance sheet cannot support losses.
Yeah.
And so you should not go around promising specific returns to clients. So some have violated that, and the SEC is looking into that because they prohibited that line of work, line of business. You know. And then some have also gone into questionable investment. For example, some fund managers have collected clients' funds and invested them in real estate.
Yeah.
And as you know, real estate is not very liquid. And so if you tie up client funds in real estate and the client is coming to redeem, how are you going to turn the real estate into cash to pay them? So that has been a problem. And I'm only reading recently that some have also made loans. A fund manager is not a lender. They don't have the capacity to give out loans. But some of them have given out loans to businesses and found ways and means of doing the paperwork in order to make it seem not like a loan. So a lot of infringements have taken place, partly because I think many fund managers thought they were trying to beat the SEC, and also because of the weakness of the SEC in surveillance.
Doc, again here in this industry, we see an issue of both culpability from the institutions and forbearance from the regulator. Now, I ask myself, looking at the business of fund management, you mentioned that some have tied people's funds in real estate. When you take a fund management firm, Doc, is there any cast in stone rule about how much you should hold on hand as cash to redeem people's investments? How much you should put into maybe real estate? How much you should put into, let's say, treasury bills or bonds? Or how much you should put into equities? The rules surrounding fund management engagement. Does the SEC spell out how much you can put here and here?
No, SEC rules, what you're talking about is what we call an asset allocation. What percentage of the total funds should go into specific types of instruments. I don't think SEC specifies that for you, but I think that prudence requires that you reach an understanding with your client. And what is normally done is that you do a risk assessment of the client and you arrive at a certain conclusion with respect to how much risk that person can carry or how much risk that institution can carry. Some are very risk averse, and you will find that out from if you do your know your client exercise carefully, you find that somebody is very risk averse. So if the person is risk averse, obviously their money should not go to real estate, which is very volatile and illiquid. Their money should not go to equities, because equity returns are very volatile. They fluctuate a lot. So you have to find instruments with stability of return, which will suit their temperament. If you're running and managing a mutual fund, every mutual fund has its objectives. Some are money market mutual funds, some are equity mutual funds, some are fixed income mutual fund. And again, the percentages that you put into those instruments depends on the nature of the mutual fund as specified in the prospectus by which you launch the mutual fund. So to summarize, the SEC does not specify what percentages of your funds you should put in different instruments. But I think prudence and, prudence requires that you reach an understanding with the client. Tell them what their options are, assess their tolerance for risk, and then invest accordingly.
Doc, not to mention any names here or put any institution on the spot, do you think some of these problems we are seeing is as a result of these fund management institutions, etc., taking advantage of the lack of understanding for the financial world of clients? Do you think they have looked at that and says, okay, you know what? These people don't understand what we are doing. Why don't we sell them any garbage products and make money for ourselves to their detriment? Do you think that's what's going on?
Absolutely. I think that a lot of that is going on. I think some fund managers have done some of these things because they thought they could get away with it. But there's always some particular client who is going to take you on. Most unsuspecting client would actually be able to see through what you're doing, and so you end up with the SEC you end up with a complaint at the SEC. So I think everybody knows that financial literacy is not very high in this country, and I think that some institutions and some of my own colleague fund managers have actually taken advantage of that and abused the system.
On the score of literacy, financial literacy, I keep on asking myself, so does it behove on the institution, the regulator, or the client to ensure that the literacy level of, e.g., someone like me, is high up here? Should it be the SEC that does campaigns to educate us? Should it be the SEC together with the fund manager and the client? Should it be the client on his own? What's the right balance to ensure that the ordinary man who has not really gone up the educational ladder can understand the basics of the financial world?
I think that there are a number of stakeholders who should be in this game. The government is a stakeholder. I mean, when people look at how much money they're using to resolve the banks, if people are losing money because they put their money into microfinance company or a fund manager portfolio and lost money, and then the state now has to come and bail them out, it's a cost to the state. So I think the government and its agencies, particularly the regulatory agencies, also have a stake in that. The industry players, such as ourselves, also have a role to play in that. Because when you have a client who is relatively literate, it makes your work easier. They understand what you're doing, and therefore they feel confident, the trust is there. And you cost society less because you're not going to create situations where government now has to go and compensate your clients for monies that you have lost. So I would say that there are several stakeholders who have an interest in financial literacy. It's not just the industry players or the regulators, but I think society as a whole benefits when its members are financially literate.
On the future of the fund management industry, I remember Reverend Obami was on Joy FM Super Morning Show, and he enumerated a number of solutions to the way forward. They are also going to undertake, and I'm sure you've seen it already, a number of reforms like we did in the banking sector. Now, we always ask this question: would this be enough to ensure that your part of the financial sphere, fund management, doesn't come back to this mess that we are seeing now?
Well, if there's going to be a cleanup of the fund management industry, it has to be combined with improved supervision. And if we don't, because if we don't improve the supervision, we will end up in the same situation again. It requires a major beefing up of the SEC, SEC supervisory capacity. It will require, for example, also strengthening the participants in the system, I mean the fund management institutions. And that will mean, for example, ensuring that they are properly capitalized. You know, fund managers actually don't need a lot of capital because they are not deposit takers, okay? But they need enough capital to be able to put in the structures and systems to make their products acceptable to the investing public, to build the trust. Some fund managers simply don't have the structures. So if you increase the capital, it will help them to be able to acquire the structures that are needed. So I don't think that there's a one-time solution that will solve the problem, but it's a package of measures continuously enforced is what is going to give us a relatively clean fund management industry. Because
when I look at the nature of the problems, there was one problem that Reverend Obami expanded on. He said counterparty
risk.
Yes, and as a result of what was going on in the savings and loans, etc., some fund managers had placed funds in these institutions. So that one would have solved itself. Once the funds are made whole to these savings and loans institutions, then the trickle down comes in. With the minimum capital requirement, fit and proper test, corporate governance code, one issue that comes up in this is the governance part. And with corporate governance code, I was going through the 2010 SEC code. I think there's a new one. I don't know if it has been finalized now for the capital market institutions, but fund managers will by all means abide by this. They say our corporate governance system is comply or explain, rather than comply or go to jail like we see in the US with Sarbanes-Oxley and etc. Will you buy that assertion that our corporate governance code is more soft on people from the fund management industry or the capital market? And should we start going towards a hard corporate governance code system where if you make a mistake, you are booked for it?
Well, a corporate governance code is effective to the extent that it is policed. And if it's not policed properly, sooner or later companies would deviate from the standards in the code. So I think that everything depends on effective supervision. If violators are being picked up and penalized because they are not abiding by the corporate governance code, I think they will be more careful if they are deviating from the code. So again, I come down to the question of effective supervision.
So I think all in all, what we should deduce from this is that apart from the industry itself taking right steps, supervision should complement what the industry is doing.
Yeah.
Okay. I want us to move on to the future of the financial sector as a whole. We've had some tidbits from you as to where regulation should head towards, etc. Where you sit right now, Doc, do you think Ghana's financial system, 5, 10, 15 years from now, we can say we've put in the building blocks, the foundation to ensure that, you know what, come what may, even if issues come, we'll have the right structures to weather the storm?
I think we have to take a look at sound regulation as a dynamic activity. New things are happening in the market. New products are being designed and put in the marketplace. New players are coming into the marketplace. Fintech, technology is developing. And so a sound regulatory system actually has to continue to adapt to the changes in the financial sector. You cannot have a regulatory system now that will be, nobody can really tell whether our current regulatory system will make sense 20, 25 years from now. So the regulators, and indeed government, because all the regulators are kind of under the tutelage of government, they have to start to think about, to be more to anticipate the changes in the market and fine-tune the regulatory system so that it can adapt to the changes that are taking place in the marketplace. For example, I think it's unacceptable that at this stage of our financial development, we don't have proper consumer protection for financial services. And a lot of products are being sold on the market, very complicated products. So that we have to be a lot more dynamic. I'm afraid we're not as dynamic as we should have been. We should have had the Financial Stability Advisory Council a long time ago. So we're playing catch up instead of being proactive, and that is what our problem has been.
I want us to go to an area you have worked in. Obviously, you will not divulge any information from there, but on the government side of things, Doc, we have had to increase our expenditure in this mid-year review. We have all been focused on the taxes that have been introduced or increased to fill that gap. We are accumulating a large or high debt as we speak. They argue that our debt composition is changing. We are shifting away from the multilaterals, bilaterals. We are going to the international capital markets, which makes our debt more expensive and essentially moved by the markets and not by institutions that can give us multilateral debt relief initiatives, HIPIC, etc. What can we do in the face of changing developments with regards to our debt and how we can make our debt sustainable? Because the Bretton Woods institutions are telling us that our debt is approaching unsustainable levels. What do we do with our debt?
Well, I think the answer is actually quite simple. We have to generate more revenue so that we borrow less. And that's not easy, because generating revenue is also quite complicated. You have to expand the tax base, broaden the tax net, and the whole business of tax administration is very complicated. Bringing the latest technology and so forth, but it's structurally reforming the tax administration system is very slow and painful. It takes time. But back to the question that you raised about how do we make our debt sustainable, revenue is very important. So you borrow less, and also how you actually manage the existing debt is very important, because you can have an existing debt stock, but you can work with it by refinancing, looking for market opportunities. If the interest rates are coming down in the market, you borrow, you pay off existing ones. So you need a dynamic liability management, which will enable you to contain the costs that are associated with high debt. And I think some of that has been going on lately. By liability management, you don't really increase the size of the debt stock. But what you're doing is you're changing the quality, the characteristics of the debt so that it is cheaper. And so debt management capacity can be improved. But I think the main culprit really is the fact that we're not generating enough revenue. Our governments are promising a lot, and they feel under pressure to meet their promises, and therefore the debt stock keeps growing.
We've examined the fiscal framework on debt, but we seem to always forget that the fiscal and the monetary have to move hand in hand. There's always the argument that the fiscal throws the monetary out of gear, and currently we are going to witness a similar issue where all these changes to the fiscal are going to bring in changes in inflation, which will feed into what Bank of Ghana has to do with the monetary policy, and that also has an effect on financial stability. What can we learn from this? Would you buy the argument first and foremost that where we are now, our fiscal state might throw off what's going to happen in the monetary space?
Well, I mean, there's obviously the relationship, but I think we've made a lot of progress in terms of trying to keep a distance between the fiscal and the monetary. I mean, one of the clearest indications of what we've done is this business of zero borrowing from the central bank. And there was a time when every time government expanded its spending, it would actually borrow from the central bank and create more money. I mean, whenever central banks is buying government securities, it's creating money. And therefore, monetary management becomes difficult. But I think we've made some progress in putting some distance between fiscal policy and monetary policy. And the Bank of Ghana's job is really try to look at where fiscal policy is going and take measures to counter the negative effects of fiscal policy. And so far, I think that we're doing a reasonably good job.
Okay. This is the business edition of PM Express. My name is Philip Namfuri, and my guest, Dr. Sam Mensah, CEO of SEM Capital Advisors Limited. We're taking a quick break. We'll be right back. Thanks for staying with us. This is the business edition of PM Express. We are at the end of our conversation. We've looked at the financial sector. We focus on the fund management industry, the do's and don'ts, the issues arising there, and how fund managers, can stay clear of troubled waters. Now, in this last part of the discussion, I want to find out from Doc what we should keep our eye on, where we should keep our focus on from either the economic space and the financial space, and what we should be cognizant of as we draw down towards the end of the year 2019. We're in August already, just a few more months and we are done with it. What should we keep our eyes on? Doc?
Okay, first let's start with the fund management industry. I think that some progress is being made in terms of making it possible for fund managers to retrieve their funds locked up in the banking system. I think quite a bit has been achieved there. And I see that a process has also started to enable the fund managers to recover their deposits with microfinance companies. But we need to accelerate the process because we haven't quite touched finance houses, where fund managers also have a lot of deposits. We haven't touched their savings and loans, where fund managers also have a lot of deposits. And then the longer it takes, the tighter the positions in which the fund managers find themselves, and the more clamoring we're going to be getting from those who have put their money into fund management companies. So some acceleration would definitely be helpful. Okay. Yeah. But in terms of the economy as a whole, I think that our challenge is really the fiscal, trying to maintain the fiscal within the statutory limit of 5%, the deficit within the statutory limit of 5%, in the face of many spending pressures, and that's a challenge. I think it's a challenge for the government.
We need to look out for it. Yeah. Doc, I want to say a very big thank you for your time here on Business Edition of PM Express. My guest, Dr. Sam Mensah, CEO, SEM Capital Advisors Limited. Doc is a financial economist by profession. What he does here on a day-to-day basis is investment advisory services. My name is Philip Namfuri, and we've been going through the motions on the financial sector, the economy, and the way forward. And I hope you've been better informed about how things work in this country. I just want to say a big thank you. And again, this has been the Business Edition of PM Express with me, Philip Namfuri. Have a good one.